this is Keith Schneider, CEO of MarketGauge.com, and this is November 4th version of Market Outlook. So, a bunch of interesting things have occurred. We had a shortened trading week, but certainly no lack of activity and volatility. So, listen, be sure to sign up for our investor sentiment survey. We'll send you those results. They may have been a little bit delayed this week because of power outages and our intermittent power over at our office and even internet connectivity to our secure service. At any rate, if you like this service as well, don't forget to sign up to get this free service weekly. Okay, so now let's take a look at the markets. Some very, very interesting things are occurring. For one, obviously the jobs report came in quite a bit better than expected and had some unintended consequences, and let's see what they are. First of all, you can see on the Dow chart a couple of interesting things. For one, you can see that we have this interesting wedge or pennant formation, and it is holding right around that 200-day moving average. Now, this pennant formation is quite powerful. You've got a low here, another low here, a low here, which attempted to bounce and fail. So what's happening here is the potential is that if the Fed QE3 doesn't really materialize as much as people expect, the pressure on the markets could continue. So this is sort of a perverse logic. Better economic news means less quantitative easing and less money sloshing around the markets, therefore putting pressure on it. And we can see that across the board in gold and the bonds as well. So we're not incredibly overbought nor oversold, so there's plenty of room to move either way. But if we can take out this the bottom of this pennant formation, and the 200-day moving average, which comes in around 129.65, you can see a pretty sharp sell-off from there. On the other hand, we're in a situation where you can also bounce nicely off of this rising trend line here and blow through the top. So you're definitely at a very, very interesting point. The market will tell you which way it wants to go. As you know, our current services will assist you in guiding through and managing how to handle the developments as the market unfolds. So in terms of let's take a look at some of the longer term charts, the weekly charts. You can see the same type of pennant formation playing out. Support definitely comes in around 125, so that's a good 4% down move if we can get if we penetrate this the trend line and the 200-day moving average. You can see on a weekly basis, connecting the bodies of the candles, we're pretty much coming in around the same level. But remember, this 129.60 level is very, very critical. Right, a lot of things are going to coincide right around those levels. Let's take a look at the spiders. Spiders doing a bit better. Why? Because you can see the longer term trend line. Let's take a look at where it comes in from. Right, from October, this is almost a 1-year trend line in the making, and you can see that we're quite a bit above the 200-day moving average. So a lot more strength in the spiders, especially compared to the Qs. Friday's action basically tested a flat to declining 50-day and was rejected, and now we're sort of holding this critical level. But you can see breaking the trend line, you're going to be also having to contend with this rising 200. So looking for again, you can possibly get a nice a sell-off. You're trading right now about 141 down to potentially 138, 3 points, about 2 ATRs, maybe a point and a half, 2%. uh, before you would see some support coming in. Taking a look at the weekly charts, a little bit different picture. You can see some major support on the 200 weekly coming in probably around 118 to 120 at worst case. Also, you can see we have the 65 week sitting somewhere around 132. So, that's a fairly substantial sell-off. But on the other hand, you can see that we are definitely on the daily charts, going back to the daily, you can see that even if we power through on the downside here, we should find some support around that 200-day moving average. Another thing to take notice is the number of distribution days. That's not a particularly good sign. You can see the volume spikes occurred on the down days. We've had 1, 2, 3, 4, 5, 6 in the past several weeks, and barely 1 or 2 accumulation days. So the market has definitely been under pressure since the ECB announcements by Draghi and the QE3 announcements that took place in September. Okay, moving on to volatility. Sentiment index. You can see we pumped above that 200-day moving average on the initial decline. We're basically hovering around it. The 50-day is starting to rise. Not particularly good. It bounced off of that 50-day on the opening on Friday, and then has been bounded by the between the 50 and the 200. Again, still within the midpoint of the Bollinger Band. So at this point, my key indicator, of course, is the 200-day moving average. We're just hovering around it, still in a relatively positive mode, but slightly degraded because of the fact that we're now trading above the 50. However, we are still trading in the middle of the Bollinger Bands. So overall, I would say sentiment is definitely trading up from the lows that we saw, which is to be expected, but nothing alarming yet. Taking a look at some of the indicators, you can see on the McClellan oscillator, our intermediate term indicator is basically a reading of neutral, nothing there. On the advanced declines, on a shorter term basis, you can see we're getting into oversold readings. In addition, we're close to getting there. We'd love to see the advanced decline and up-down volume ratio get to oversold readings, pop through it to generate a coincident buy signal. Not quite there yet, but if we get that test of the 200-day moving average in the spiders, that could look really, really good. So just to clarify what I just said, a reading of oversold on advanced decline with the up-down volume along with a test of that 200-day moving average would really coincide nicely. Let's move on to the TLTs. These are the long bonds. Really straightforward. We've been highlighting the declining channel here. We've had a series of tests. Again, you actually tested the top of it this week and the 50-day moving average. Also tested the 200-day, so you're really getting squeezed. A bit of compression here. For those option players, you may want to take a look at the volatility because with this level of compression, you might have a mispriced option scenario. However, what is most interesting is along with the market move down, you can see that the TLTs, these bonds, actually were down on the day. And that's a pretty interesting divergence between what's been happening. Generally, the market, gold, has been dependent upon bad economic news, more quantitative easing, more monetary stimulus for a rally to materialize. So that has not occurred. Let's take a look at how gold reacted to the same news. As you can see, gold really got smashed on Friday, right? You had what looked like a historic move to potentially test the highs. You can see we failed this trend line, sort of got a meager back test of the upper end of it, and has failed the 50-day moving average, tried to test it earlier in the week, failed, and got a very substantial sell-off of over 2% in GLD. Now, interestingly enough, we're neither overbought nor oversold. So first thing is potentially look for some support to materialize, maybe around that 200-day moving average. Let's take a look at some of the longer term stuff. Okay, interesting. On the weekly charts, clearly on a weekly basis, we're on a relatively oversold basis, but at the same time, we're breaking down through this 65-week moving average. Not a good sign. So real potential for the market to have a throwback move, return move to this trend line. So it could see more weakness. Remember, gold, very much sentiment driven. It's a commodity. It has a tendency to get to extremes. You can see over here on the RSI, when we got overbought, we stayed overbought for several weeks. Same thing can happen on the downside. So definitely bears some merit. Obviously, if we can pop through and get through the highs that were made earlier this week, you might have a reversal right around this trend line. Again, in terms of key resistance points now, it's this 50-day moving average and also this particular bar here. So really a reversal of trend either around 169, or maybe we consolidate some here around 161 and let the market try to build some support around this level. Otherwise, we're looking at, again, a more severe sell-off and testing the initial breakout point that occurred over the summer. Seasonals, by the way, are generally very strong and supportive to gold and precious metals around this time of year and well into January and February. Okay, one other thing to cover. Well, we're going to cover two other things. We're going to take a look at Apple. And clearly the Apple chart has not held up as well as one might have expected, considering all of the convergent indicators. Let's take a look at that. You can see Apple now tried that bounce off the 200-day moving average. We're very oversold on a weekly basis, down to 0.79 on a weekly basis. We haven't been there at that level since 2008 on a weekly basis. Now, that doesn't mean it can't get more oversold. That's why we were looking for the bounce. If you remember last week, we basically had been looking at the convergence of several indicators, right? That rising 200, oversold on the weekly, look like you might have a potential for a bounce here. Meanwhile, we closed strongly through the 200-day, so we definitely liquidated as we couldn't hold these that 200-day moving average on Friday, and we're going to again keep an eye out on this Apple chart. Meanwhile, more pressure on it. What are some if we continue on the down, what is some potential targets? Certainly this rising 65-week moving average. You can see that's a pretty strong support level, has been acted that way certainly in the mid part of 2011, all through there, and we just accelerated so far. So coming back down to this rising 65-week moving average might offer some support, and that's coming in right around the 517 level. So, that's a fairly substantial sell-off. That's another 10%. It also will coincide with the sell-off that occurred earlier this year. So, again, likely support level, maybe a little bit higher there, but again, on these intraday moves, you can certainly penetrate a point, come back through it. We've seen $20 rallies within half hour to an hour in Apple. You can see the ATR now is $30. So this stock is definitely in play, and it's fear and greed. For now, you might want to throw out what you might consider long-term fundamental readings at $30 a pop. That's a significant volatility factor. So you definitely want to make sure you're trading off of the technicals, managing that risk, along with understanding, if you're a fundamental player, what the valuation levels might be. We're not going to get into that here, and it's beyond the scope of what we do in Market Outlook. So one last thing. Let's take a look at FXY. This is the Japanese yen. Interesting. Let's start with the daily chart. You can see definite topping formation. We're in a distribution mode right here. Once we drop through that 200-day moving average, definitely in a distribution mode. We're now trading beneath the 10, the 200, the 50. Japan definitely had some economic news that was not favorable. The stimulus after the tsunami has sort of worn off. The economy is definitely slowing down strongly. The Japanese yen has held up surprisingly strong for many, many years, fooling many people. This potentially could be the start of something significant. Let's take a look at some of the longer term trends in the yen here. You can see we're also now trading beneath this 65-week moving average, and it's flattening out. So wouldn't be surprised to see 116 level support coming to the 200 weekly, and then there's a real potential longer term that the Japanese yen meteoric rise over the decades has come to an end. Let's keep track. Again, the key point is going to be this 200-week moving average and what it does at these key levels. All right, so that wraps up this week. You can see definitely the TLTs, bonds, potentially under pressure. We want to clearly see the that upward trend line or channel line not be broached, and if we can take out the recent trading levels, you can see another test of that downward channel. So keep an eye on all these markets, definitely going through some changes, and they are significant. Thanks. Have a great weekend. And again, don't forget to participate in that investor survey and sign up for this video and text newsletter, and you'll get it free on a weekly basis. Thanks, and bye for now.